Week in review. The Federal Reserve, the folks who handle interest rates, are facing a tough challenge in their quest to reduce inflation. Imagine it's like running a marathon and they've reached the last mile. But this last mile isn't a walk in the park. It's more like climbing Mount Everest. Here's what happened. They looked at something called the Producer Price Index, or PPI, which tells them how much prices are going up for things that companies buy. And guess what? Those prices are rising. Now, the Fed has a cautious attitude. They're like, let's wait and see what happens. It's a bit like when you're deciding whether or not to buy that new fancy gadget or not. They're keeping an eye on things. But here's the twist. People expect prices to keep going up. That's called inflationary expectations. And when that happens, it affects everything, like a domino effect. Bonds and stocks got a little bit shaky this past week. The S&P 500, which tracks big US companies, stumbled just a bit. Imagine it doing a little dance move called the 21 basis point backup because of the move in the 10-year US Treasury note yield. The week ahead, the Fed is having a meeting, and it's a big deal. They'll be talking about interest rates, the cost of borrowing money, and making decisions. Imagine, it's like they're playing chess with the economy. Why does this matter? Well, it affects how people feel about the stock market. If the Fed hints at cutting interest rates, like giving a discount on borrowing, investors might cheer. But if they say, oh, no rate cuts for you, well, the stock market might pout a little. So keep an eye on the Fed. And this week, their decisions will be front and center, like the star of a blockbuster movie.